WPAs. It's a 5-point, a 10-point, a 20-point, a 25-point, a 50-point level. You know, it's going to have one of those elements, right? It's going to have one of those elements attached to it. And obviously what happens is that there's a lot of sellers in front of this, and everybody that didn't have their stop there will have their stop there, correct? And what happens as a rule is the price will come up into this area. You'll get the usual possible defense of that area there, and it sticks around, and then all of a sudden it goes, and it'll go through that price. And the idea there is, of course, you're picking up a lot of buy orders. The question is, that's the last buyer that's probably in this market. And if it is, the price will immediately reverse back out of that area very, very easily. And then the price sells off. Make sense? We'll look for these on the screens. We'll look for these on the screens today if you're interested in that as a basic process. But it's like every 10-point move has that same quality about it. Bookmap's probably the best product for it, Ab, to be honest, and that type of idea. But obviously you can use a depth of market. I mean, it's not a difficult thing to see it on a depth of market, on any depth of market, for example. Here's the yen, for example. Can everybody see that this price here breaks the 68.80 level? So, but all the liquidity at the moment is obviously sitting in here at 81s and 82s, right? So the 80 level isn't a high liquidity price. So you can see that the liquidity now is sitting at 81s, 82s. So you're obviously looking at that as a process and saying, okay, well, it's probable that it's going to, if it's bullish, it's probable that it's going to run through there, and that's where we'll make a decision. It's probable that that's where we'll make a decision, and we'll be able to get a bit of a readout of that narrative at that stage, right? So in other words, there's a real-time element to this in terms of your order flow. You can see on the S&P that you can see these areas as well. I mean, I've kind of jammed the S&P in really tight here, so it's very difficult to see those elements. But, you know, it's relatively easy to spot where the real liquidity is, potentially, and just pay attention to it. There it is there, 44.34. And there it is there, 44.35. 44.35 is a natural level. So if you're a seller, I'd be selling 36s at the moment. I'd be selling 36s because obviously if it hits that 35 and sellers come in and then they spring those sellers into a trap, they'll probably sell it at 36s and then take the market south. So this is one of the things that we start to factor into our thoughts in terms of levels, in terms of liquidity plays, in terms of things like your book map or your order flow charts on NinjaTrader, or Sierra Charts has them as well. Sierra Charts has order flow in depth as well, and if you like Sierra Charts better, if you prefer that platform. But certainly in terms of visibility, the book map product is obviously very, very easy to recognize. But you should be paying attention to big stacked liquidity anyway, as a rule, because, you know, it's very, very important when we see a price coming off a level that we see the big stack coming back onto that level, and recognizing stack liquidity that's been around for a while is very, very, very important. That 79.60, for example, in oil has been around forever. There was a big level at 50, as you'd imagine. There always is going to be a big level at 50. But there was a pretty big level at 60 as well, as you would imagine, and there was a little bit of a level at 70. So that 79.60 was always something you were paying attention to. And that's relatively easy to now recognize, isn't it? So if we look at oil, for example, if you look at oil here, this was earlier on, and you can recognize that there was this 70 key level. There was a buyer came in at 70, and now we can recognize that liquidity at 60, and we can recognize the very big liquidity at 50. So all of a sudden we've now got a trade, haven't we? Because we're now looking at this at 70 and saying, well, we've got stops below here, and we've got the next key level is going to be 60, right? Agreed? So obviously if I'm looking at this from a floor trader's point of view, I probably can flush all the stops out this market at 60. So from a floor trader's point of view, that's the trade I think that's going to work for me. Right? That's the trade I think that's going to work for me. So when the price trades down into that area, you can see that we take out that first liquidity, and unfortunately, you know, it didn't quite manage to get that extra last leg of business. And obviously the market went bid against that price very, very aggressively. But you'd have been aware of that because it's only like 1 or 2 ticks away from where you're going for a bid anyway, right? If you look at it from a seller's point of view, this was also the case. If you look in the background, you'll see that we had this wholesale price at 80. So that's obviously, you know, we don't have any structural sells there. So we know that that's where the big liquidity is at. We know that the stops are probably going to be above that price, correct? The stops will be above that price. And we can also recognize that at that stage, the next level would probably be somewhere here, right? You can see it. There it is there. It's no surprise. It's 10, 80, 10. That's why we jumped 10 points on these oil trades, right? 80, 10. So we're looking at that as a possible sell trade at 80, 11s, 80, 12s. Does everybody agree with that? Now, obviously, it didn't play out because obviously the sellers came in and took the market offered very, very nicely from there. And then the liquidity fell back in at 80s again. But this time, do you see where the liquidity came back in this time at 5s? So what we can do now as traders is we can now look at that 5 and we can now sell 6s. You see it? So we can now sell 6s against the stops that are undoubtedly going to lean against this 5. And the good news is we get a chance to see what, Paul? What do we see, Tom? What do we see, Ab? What do we see, oil traders? We get a chance to see whether the liquidity is real, right? We get a chance to see whether the liquidity is real or whether it's a spoof seller. If the liquidity is real, we'll see it. They'll then pull away the liquidity if the buy-in keeps coming in. We'll get the chance to then sell at higher prices, having seen that liquidity. So in other words, we should get a Voltic kicking off. We should get a buyer getting jammed. Hopefully, we should start seeing the volume delta and the tick delta diverging into that price. And obviously, we can then get the business done on the retest. As we break above the 5s, we're selling 6s and 7s. And then we can pop a little short sell in at 4s if we wanted to instead of selling limits. And that way we get verification. By only giving up like 2 or 3 ticks, we actually get verification that the absorption is in place. We can then watch for the book offers coming in behind the deal, and we can join the play to the sell side. And obviously the play to the sell side, well, you can see it went back up a 3rd time and retested. That's okay. That doesn't bother us. And down she went. $300 profit per contract on the swing down. Pretty good order flow trade, right? Pretty good order flow trade. So this is what we're looking for, isn't it? These are the things that we look for as order flow traders. I'm assuming that's what everybody looks for as an order flow trader, is these types of setups. Because obviously as order flow traders, we need every edge we can get our grubbies on, right? We need every single edge we can get our grubbies on. And as we build out these edges, you know, we start looking for the response. We start looking for the Voltics. We start looking for the jams and the leans at prices. And if the buyers come in and the sellers don't, we simply have to jump. We have to jump. You know, if you were waiting for that break below 60 on the oil and the price only traded at 62s, you need to jump at 63s. I mean, you're giving away some money, but what are you giving away if you still think there's a buy trade there? And obviously that trade was worth what? $600 a contract. It's for $30 of extra risk, you made a $600 winner. Yeah. So we understand the process and we understand, you know, just why that trade made a lot of sense and why the trade worked out. Now, turning to the value of the trade, of course, it was a no-brainer buy trade anyway. I mean, I'm surprised there wasn't a billion people writing in earlier on the room, did anybody see that buy trade, by the way, at 70, 60 level? I'm hoping all the oil traders saw it. My God, if you never saw that. All the oil traders? Paul, are you the only oil trader in the room now? So Paul's the only bond trader and Paul's the only oil trader we've got left. I thought Reeve was an oil trader. What's Reeve trading? Gold! Reeve's on gold. What's Sammy trading? Anyway, look at the value going north. Look at the yields going north. Look. Is that not an obvious buy trade off the 60s? If that's not an obvious buy trade, I don't know what is, guys. I don't know what is an obvious buy trade. That's a banker buy trade. That's not a buy trade. That is, if you miss this trade, you're a numph buy trade. Yields are rising. The spread kicks in. We then get that liquidity run off the 70 that we've just been talking about. We then see the stops at 50. We think about buying below the 60s. Doesn't happen, so we have to cross into this spread, which is why we get this enormous candle here. Because everybody had to cross into this spread because nobody got filled below 60. So everybody had to cross. If you're one of these typical retail traders that can't cross the spread until 60 seconds have elapsed, your perfect buy price was there. What a numph. So that's kind of pointless, isn't it? That's worse than pointless. That's going to damage your book massively. So unless you're in around about that 60, 61, 62, 63, 65, 68, 67s, unless you're in those areas, you should just pass on this trade and wait for a pullback or another storyline because you've missed the deal. You've missed the deal. And you've got to get in it somehow because obviously, because it never ran that 60, you know there's a lot of crossers in this game. Well, take advantage of it if you know that. Take advantage of the crossers if you know that's what's going to happen. Jump in early. Get your monies. There's a lot of monies to be get. 32 gold, just traded 22 gold, just about for $1,000. Congratulations on that short sell on gold. That's the one I think Reeve was on. That's why Reeve's not on oil. So that's the trade that Reeve was on, was that short gold position, I think. So congratulations anybody else that was on that bit of business on gold. I like it. And you could have spread that against your yen position as well. Remember that. You could have easily have spread that against your yen position. So congratulamundos. Very good indeed. Remember, one of the best outside market lines, because it's not really an outside market line, but it kind of is your real yields. Real yields, not oil prices, but real yields. It's one of the best outside market lines you can put on your screens because it shows you whether there should be some supply or demand coming in. Remember, simple positive correlation or negative correlation, your shout. But if you look at how nice that sell on oil was against real yields, you'll see just how easy it was for us to work into that as a short sell. How easy it was for us to work into this as a walkaway and a possible buy trade reversal. It's not hidden from view, is it? You might be saying, but what about this buy reversal here? Well, yeah, but, you know, there's not been any buying at that stage. I'm not going to buy on the down move. Since the value came in, there hasn't been any buying, has there? So I'd be buying on the retest of this. And obviously, when the retest came in, the real yield was gone again. So there's no buy trade. There was buying coming in here. So when it retests, I've now got that trade to buy into. That's how you use divergence, I hope. And there's your buy reversal off the 26s after we exited the short sell, which we had off the 20s here. Simple, easy to use lines. Just focusing on them, making them your drivers, making them of elevated importance, and not just jumping between lines because we happen to cover something else, but sticking to the ones that make you money. It's probably really important for most people. And then add in your order flow elements. Russell stuck at 73, 74s. S&P stuck at 44.40s, which opens the door to a possible buy away down at 44.15s. Now, that would be a bit of a disaster story if the S&P ended up down there. The hope is, of course, that the NASDAQ gives us a bit of support at 15,060, and it holds the S&P drop in check so that we don't end up all the way back, basically giving back the entire US sessions long position, right? So that's what we're hoping to see. Whether it's good enough or not, we'll figure that one out soon enough. Cash open, guys. We are off and running. Yesterday, those max diffusion trades, there was 13 of them. Sorry, there was 14 of them, my mistake. There was 13 winners and 1 loser for 4 ticks. 13 winners and 1 loser if you were just using a 4x4 narrative. So on that basis, if you were using 2 contracts and you were simply looking for $100, you would have made a $1,200 profit on the day itself, which is a pretty good income on a 2 lot.